Ever wondered what it truly means to be in a Great Depression? If you're under 90, you probably haven't experienced one firsthand. Today, we're going to dive into what experts are calling the new Great Depression and why it's more relevant to our lives than ever before. We'll also reveal a key asset that could safeguard your wealth during these turbulent times. Jim Rickards, a renowned financial expert, recently stated that we are already in a new Great Depression. Unlike the 1930s, characterized by continuous GDP decline, today's depression is marked by growth far below potential. Imagine an economy with a potential growth rate of 3.5% annually. If it only grows at 1.75%, we're experiencing depressed growth. This might not sound as dramatic as a complete economic collapse, but it's just as concerning. The issue gets worse when you factor in debt. If a country's debt is growing at 5 to 8% per year, but its GDP only increases by 1 to 2%, it means debt is outpacing income. This imbalance can lead to insolvency and significant economic instability. Such a scenario is not hypothetical, it's happening right now. As Rickards warns, this is the reality of the new Great Depression. The COVID-19 pandemic accelerated this shift, but the seeds were planted long before. Let's take a step back to 1929. The stock market hit a peak, then crashed by 90%. It took until 1954, 25 years later, for it to regain its 1929 levels. The Dow Jones Industrial Average reached 381 points in 1929, crashed to around 30, and didn't hit 381 again until 1954. Joseph P. Kennedy, one of America's wealthiest men, made his fortune by shorting stocks ahead of the Great Depression. This historical insight shows that, with the right foresight, you can profit during depressions. Are we heading towards inflation or deflation? Experts are divided. Peter Schiff has his definitions, but Jim Rickards emphasizes aligning with major financial institutions like the Federal Reserve. According to Rickards, inflation isn't solely driven by the money supply. It's about the velocity of money, the rate at which money circulates through the economy. If you increase the money supply from 4 trillion to 7 trillion, but velocity is zero, economic activity doesn't increase. Velocity has been dropping since 1998, nearing zero, indicating severe deflationary pressure. Let's break it down with an example. When you tip a waiter, who pays a taxi driver, who buys gas, your dollar has a velocity of 3. High velocity means spending and investing, stimulating economic activity. Low velocity, where money sits idle, means zero economic activity. This behavior is psychological and cannot be directly controlled by central banks. Historically, Franklin D. Roosevelt addressed similar issues in 1933 by increasing gold prices, encouraging spending. Today, people are saving more, much like in China, rather than spending. High savings rates, while seemingly beneficial, can lead to economic stagnation if not balanced with consumption. Jim Rickards points to gold as a safeguard against these economic woes. Why gold? Rickards predicts that gold could hit $15,000 an ounce by 2025, based on historical trends and monetary analysis. He notes 3 major bull markets for gold. From 1971 to 1980, gold rose from $35 to $800 an ounce. From 1999 to 2011, it surged from $250 to $1,900. Now, Rickards believes we're in a third bull market, which started in December 2015 when gold was $1,050 an ounce. If the average increase from the first 2 bull markets is applied, gold could see a 1,400% rise, reaching nearly $15,000 an ounce. But Rickards doesn't stop there. He employs a monetary analysis, suggesting that if global confidence in fiat currencies collapses, central banks might revert to a gold standard or partially back their currencies with gold. To back the global money supply, estimated at $33 trillion with gold, you'd need about 34,000 tons of gold. This would translate to a gold price of approximately $14,000 an ounce. Moreover, Rickards explores the economic principle of diminishing percentage increases. As gold's price rises, each incremental gain becomes easier. Moving from $2,000 to $3,000 is a 50% increase, but $14,000 to $15,000 is only a 7% increase. This suggests rapid acceleration in the latter stages of a bull market. Therefore, Rickards urges not to wait until prices peak. The bulk of gains typically occur near the end, so early investors benefit most. Even legendary investor Warren Buffett, historically critical of gold, has begun investing in gold mining companies like Barrick Gold. This indicates a broader recognition of gold's potential in the current economic climate. Investing in gold mining stocks can offer leveraged gains compared to physical gold. As gold prices rise, mining companies' profits can increase exponentially, making them lucrative investments. Buffett's strategy underscores Rickards' point. Gold mining stocks can provide significant returns as gold prices climb. These investments highlight a growing awareness among seasoned investors about gold's role as a hedge against economic instability and currency devaluation. In conclusion, the signs of a new Great Depression are evident. Depressed growth, increasing debt, low money velocity, and high savings rates all point to a troubled economic landscape. Gold emerges as a key asset to protect and potentially grow wealth during these uncertain times. By understanding the dynamics at play and acting early, investors can safeguard their financial future.